markets like to climb a wall of worry, as they say. So there's plenty of skepticism out there, and that's a good thing. Future fuel for the market. And my view is we're in the 42nd year of a secular bull market that started in August of 1982, the final stages of that. But I think the last stage is going to be the steep, dramatic stage. So we just came through a 2-month consolidation. Your market corrected from mid-July, had sell-off on August 5th when the yen carry trade reversed, and has spent the last 10 days or 2 weeks retesting, basically a partial retest, not all the way back down. We've come out of that and turned back up. I think about to start what I call the parabolic leg of the secular bull market. So I've been talking about a melt up for several years. We had a melt up in 2020 and 21 when the market was up over 100%. Then we had the bear market in 2022. And since October 22, we've been in this new bull leg. I think it's going to steepen as we move to the top. I think the top could happen this year and probably will happen this year. There's no magic to the calendar end. If it carries into the first quarter, so be it. But I actually think the likelihood is that we see the top this year. My target for the indexes are S&P 7,000, NASDAQ 24,000, Dow 55,000, and the Russell 3,300. So I'm talking 30 to 40% upside with the Russell, maybe 50% upside from here. And to say that can all happen between now and the end of the year is crazy, I know. But that's what I mean by a parabolic final blow off. I don't know exactly when it's going to end, but it's going to be that kind of a steep run into the end. Whether it takes 3 months or takes 5 months, nobody can know that for sure. But I would bet we see, if not all of it, most of it this year. Part of the thesis is that a market will steepen into its final top. So, the legs just get steeper as you move. We've had pretty steep runs. NASDAQ from 10,100 to 18,000 plus in the last 2 years or less than 2 years. And this last leg's just going to be even steeper than that. So it's the nature of how markets kind of come to a finality. And because this is a 42-year bull market, 42-year secular bull market. There have been cyclical bull markets within that and bears, but it's a 42-year secular bull market. I mean, we don't see those often. Obviously, that's a long run. And so I think the last piece of it is going to be the most dramatic. And besides that, what you've seen this last couple of years is a lot of skepticism and a lack of belief in this market. So from October 2022 all the way up, at least until we got to, let's use the S&P, from 3,500 at the bottom on October 13th, 2022, it ran and people kept saying all the way up, this thing's going to roll over and go to new lows. They believed that all the way up, that it was just a bear market relief rally and it was going to roll back over and go lower. They believed that all the way up until probably 4,300, maybe a little higher. And then they started saying, maybe we're wrong. Maybe this thing has legs. So they thought maybe it can go back to 45,600. From there, it pulled back to 4,100. And they were sure that was the rollover again. It wasn't. Obviously, from 4,100, we were off to the races to new highs. Once we got to new highs, particularly once we got over 5,000, you had more people jump on the bullish bandwagon. All the way up, they were really not believing it was a new bull market. They thought it was a bear market rally. So we've gotten up to 5,600 and change, then pulled back for a couple months. Now we're about to go new highs. And I think as they see it to new highs, along with a Federal Reserve that is about to start a new easing cycle, I think the combination is going to get this thing going. So both technically, it's going to be free sailing. And secondly, I think people are underestimating how important it is that after 2.5 years of Fed tightening, we are about to start a new easing cycle. Easing cycles don't come around often, and when they do, they usually do signal something. And I know there's a chart that's been going around for a couple of years that when the Fed starts cutting rates, it's time to head for the hills, that signals the end of the bull market. That's typically not true. It's not always true. What that chart is signifying is that when you are going into a really rough downturn and the Fed finally recognizes it, that means you're just beginning to start the rough part of the downturn and you better sell your stocks. This time around, right now, we have a soft landing look to the economy. There's nothing there to say we're heading into 2008 or 9. This is one of those rough downturns. Right now, the narrative on the street, and I think the continuing narrative will be for the next few few months, soft landing. That the Fed engineered this well. They got inflation all the way back down to their target, and they didn't have a recession to get there. So now they're seeing the signs that if they go any further, they're going to have a recession. So they're turning the other way. When you have that go on, where you're just flattening out, you're not heading a lot lower in the economy, then you react to a Fed cut or to an easing cycle in a very positive way. Now, I have to tell you, I'm looking for a global bust next year. So I'm not saying that's my forecast of where the economy is going, but I'm saying that's the Wall Street forecast, and that's the Fed's forecast of where things are going. So for the next several months, there's nothing right now to tell you we're heading into a global bust. I have reasons why I think it's going to morph into that later. But for a few months, you can have your cake and eat it too, where you can have the wind at your back from Fed easing, earnings expectations moving up for next year, and people still are not bullish, so they have to commit money because they've been defensive. So I think that's what the next few months means, and I think you're going to see it build on itself so that you'll get FOMO, you'll get a lot of that bearishness is going to turn into bullishness. And as I say, at the very top, everybody's going to be all in. The Fed engineered a soft landing. We have a big cycle ahead of us of ever higher earnings for the next couple of years at least. That isn't necessarily going to be the case, but as you know, at the top, you're most bullish, and that's what we'll see. We are most definitely in a bull market. As you know, once we got hit hard in early August, the story out there became, we made a double top. Basically, we went to 5650 and went down to 5200 or whereabouts, went back up to 5600. So people thought that was a double top in August, early September. And if we're going to push to new highs here as we are, then that takes away that double top. It may take a little while, but I think people are going to be within the next week or two jumping on that bandwagon saying, wow, this thing has a lot of legs. As to things to worry about, obviously I can be wrong, but I can't stress enough. There is so much skepticism out there. We're at all-time highs, and you got everybody worrying about what's coming on the downside, right? Everybody's assuming this thing's close to the end. And what I keep saying is time-wise, we may be 3 or 4 months from the end. But if I'm right about my targets, and they're high conviction targets, we're talking about 2 and 3 years worth of returns still ahead of us. That's what makes this such an unusual period is if I'm talking 30, 40, 50% returns, that normally is something you get over, if you get 10% a year, that's 30%. If you get more than that, a huge year, especially when inflation is down under 3%. And yet I'm saying you could get that in the next 4 months. So it's pretty phenomenal what I'm describing here. It's a combination of a blow-off top, which means people get irrational, and the fact that they underestimated how much was still left in this in terms of earnings, in terms of the resilience of the economy, etc. So I'm not focused on what can go wrong because I think everybody's already focused there, and what you should be focused on is what can go right. Well before the carry trade issue, I've had a forecast out there that the yen would finally bottom out and that we would see a 0.0085 yen to dollar. So everybody else does the dollar to the yen, but yen to the dollar, 0.0085. It had gotten way down there. So I'm not surprised by this rally, and everything I look at in the chart says it's going a lot higher. However, I don't think it's going to lead to another shoe dropping in terms of the yen carry trade. I think all those that had to get out because costs were rising fast and they were leveraged or they had borrowed and they couldn't carry that happened that day. Obviously, you had the panic selling. But then you had a period where the yen pulled back some and the market rallied. So I think the balance of those that had to get out because of the carry trade or wanted to reverse the carry trade, a lot of that's already happened. It happened more gradually after August 5th. So I'm not worried about that, at least not now. I think that's kind of in the rearview mirror at this point. For a couple of years, I had said it was very clear to see that Powell had bought hook, line, and sinker into Bill Dudley's thesis about the importance of getting the market down to tighten financial conditions. This is going back to April 2022. But for the next year, it was a real concern that, if the market's going up, we're not tightening. We're not tightening enough. We need to get that market down. And I criticized Powell a lot during that period and said, your job should not be trying to decide where the market should be. Bill Dudley's wrong. The market, in its infinite wisdom, will go where it goes. Your job should be focused on the economy and inflation. So he had his head handed to him several times in 2022, particularly the latter part of 2022, when the market went up, when he was calling for it to go down. Every time they had a Fed meeting, and then thereafter. If the market rallied on his comments, he'd have his minions come out and talk it down, right? You could see there'd be one after another would talk about, trying to get people bearish again. It was foolishness, a waste of energy. He finally abandoned that probably in the first half of 2023, and he hasn't shown any interest in trying to call the market since then. So there is a possibility if we get this market up on stilts like I'm calling for, that he might say, hey, we got animal spirits out here going crazy, speculation's going crazy, we have to tighten back up. That's possible, particularly if that leads to a bounce in the economy or bounce in inflation. You could see him come back the other way. That would fit into my global bust thing, that they would be zigging when they should be zagging or what have you. They'd be tightening on the eve of what is already a very dire situation. I don't know if he's going to do that or not. What I do know is they're not focused on money. They're focused on rates. They're keeping the balance sheet. They're still shrinking the balance sheet. They're still letting roll-off happen and not replacing it. So you are seeing some tightening on the money side. At the same time, they're about to start cutting rates. I think it's becoming less. The last several months, they haven't been letting as much roll off or haven't been shrinking the balance sheet as much. But money still matters. And there is a point at which they're not realizing that even if rates are coming down, if they're not boosting the balance sheet, they're not easing. So there is a point there. But for the next several months, you're going to have the wind at the back in terms of rates are coming down, Fed easing. The bond market, and I've said this for a long time, the bond market leads the Fed in terms of rates. So when everybody was focused on, is the Fed going to ease? Is it going to be a quarter or a half? I go, it doesn't matter if, 10-year rates have already dropped over 100 basis points. And now they've already dropped 135, 40 basis points. So you've already had the easing. Much more easing there than you're going to get out of the Fed. I'm calling for a 2.5% 10-year this year, whatever, with 365 now. So I'm calling for it to go to 2.5. So, and then what I call global deflationary bust, I think you could get the 10-year down to zero. That's during the opposite of what we're getting now. You're going to have a huge financial crisis and economic downturn next year, not this year. I don't know exactly when it starts, but then the Fed will have to get a lot more aggressive than they will here. But just focused on this year, I think you will see 50 basis points next week, and I think you'll see at least 2 more 50s between now and the end of the year. That's my guess. But, I'm pretty sure they'll cut in November, and again, unless they get turned off by the market being so high, you probably get another one in December. I raised my silver target from 60 to 75 back in my July letter, so that's pretty recent. I think silver and gold are just starting what I think are going to be huge moves. You could see both of those targets reached in the first quarter is my guess. So I think you're going to see stocks and bonds and metals all move together. And I know people have been frustrated by the miners. Now, in the global bust next year, I think both gold and silver will be hit hard. Gold, if it goes to 3,400, could come back to here. So it's not a straight line. Again, my big call beyond the bust, because they're going to be printing money like crazy to pull us out of the bust. By the end of the decade, I see gold going to 20,000 and silver going to 500. But as I said, it's not a straight line. You got to worry about next year. If we have a global bust, there's going to be a big correction. So it's not a buy and hold idea where people can do whatever they want. But I think they'll be disappointed if they buy here, let it have the big gains, and then lose them in the bust. So, just kind of cautionary tale there. I think we're going to have a huge commodity boom, which will include energy. And I think oil could get to $500 a barrel by late this decade, early next.